are going to study cost accounting. Costing is a specialized branch of accounting. It has been developed because of limitations of financial accounts. In financial accounts, we study, you see, profit and loss account, then balance sheet. For the last, you see, we collect 3 years balance sheet from the company. We compare the sales of the company. We compare the ratios. Suppose company is applying for limits from the bank. So bank will ask the company to submit past 3 years, you see, financial statements, that is trading account, profit and loss account, and balance sheet. And then bank will compare the sales of these 3 accounts. Bank will compare the ratios, that current ratios, current asset over current liability, then debt equity ratio, debt divided by equity. If the company has applied for a term loan for buying any machinery, then bank will calculate the debt service coverage ratio. So in financial accounts, in companies, they have to submit the audited, every company has to get its, you see, results audited by the chartered accountant who signs the balance sheet, profit and loss account, and they have to, you see, send these statements to the registrar of company's office. It is compulsory. It is compulsory. Every company has to submit its balance sheets to the registrar of companies. They have to they have to discuss about the balance sheet. They have to pass the balance sheets in the annual general meeting, and after that, you see, chartered accountant will check, he will sign, and then company has to submit the balance sheet to registrar of companies. Financial accounts, you see, that is that tells about the financial position of the company. You see, whether it will, how much funds it will be needing, how much sales the firm is projecting. Then they approach banks also. If they are already having the limits, they will ask the bank for review of limits. If they are not having credit facilities from the bank, they are having only a current account from the bank, and if they need credit facilities, then they can apply to the bank for financial, you see, assistance for granting of, you see, limits, and bank requires these audited, you see, balance sheets. Then for future, bank will need, you see, projected balance sheets. Banks, you see, sanctioning of limits depends on the sales. You see, bank can sanction up to 20% of the sales working capital limits. If a company requires the working capital limits, so bank can sanction 20% of the limits. Suppose the sale of a company is projected in this financial year 1 crore, so bank can sanction a cash credit limit of 20 lakhs to the company, that is working capital limit. Besides this, if the company needs term loan, bank can see the debt service coverage ratio of the company. If it allows, bank will sanction, you see, term loan also to the company. If the company is in a position to service the, you see, EMI, then bank will definitely sanction. So all these things, you see, financial results, all these things depend on the financial results. Whereas cost accounting is concerned with, you see, ascertaining cost, controlling cost, and reducing cost. In every business, you know, they want to increase the profit. Now, how the profit will be increased? Profit will only be increased when they will, you see, curtail certain expenses, when they will reduce the cost. In the present day, it is absolutely necessary that a business concern should, you see, operate its activities with utmost efficiency and the lowest cost. You see, every business, they want to, you see, make the cost minimum, and they want to increase their profit every year. The term cost has a wide variety of, you see, meanings. Different people use this term in different senses for different purposes. For example, buying a book, you generally ask, how much does it cost? You see, anything. Suppose you are taking a room in a hotel, how much it will cost? You see, how much it will cost? This is very common, very common. Here, the cost means the price. You see, what is the price? The costing terminology defines cost as the amount of expenditure incurred on or attributable to a given thing. You see, how much money, you see, incurred for making this particular item. So here, this costing terminology, you see, defines that. Costing is the technique and process of ascertaining cost In simple words, costing is a systematic procedure of determining the unit cost of, a product, service, how it can be, reduced. Now, analysis and ascertainment of cost. The main object of costing is to ascertain the cost of each product, process, department, service, or operation. Now we take the example of a bank. Bank bank collects deposit for the purpose of lending. Now, when they decide about the lending rates of interest, then they see this deposit, how much it is costing to them. Then after that, they add in that some profit. Then they quote the interest for loans. Presentation of costs for cost reduction and cost control. Important function of costing is to control and reduce costs. In an organization also, if they have to curtail the expenses, what they do, they find if some extra, some staff which is extra, they will post them to another branch, so that of that particular branch, salary will reduce. So naturally, expenses will reduce. Planning and decision making, it has now developed as a tool in the hands of the management for planning and taking crucial decisions like pricing of product, introduction of new product in the market, make or buy, decisions. There is so much competition. Now, management also, devotes a lot of time in this about, pricing of the product, then what new product should we introduce in the market so that the sale will increase and there will be demand for that, product. What additional features, should be added in that particular product so that, sale boosts up, Now, concept of cost, the cost, refers to expenditure, not the price of any good. It is how much money spent in making that unit. It is the process of ascertaining the cost. Its interpretation depends on the nature of the business, or industry, and the context in which it is used. The process of accounting for cost from the point of which expenditure is incurred or committed to the establishment of its ultimate relationship with cost center and cost units. The amount of expenditure incurred on or attributable to given thing. Cost accounting is considered more a technique for cost control. It is a technique than merely for cost ascertainment. More emphasis is given on cost control due to technological developments in all fields. Cost reduction has now come within the ambit of cost accounting. It is thus concerned with ascertaining costs, controlling costs, and reducing costs. For example, if you want to reduce your electrical usage charges, so what you will do, you will put more emphasis on in whichever room it is not required, we will switch off the AC is the light of that room. We will constantly watch. Whenever it is not required, we will switch off the electricity. So naturally, our bill will come less. Now, classification of cost. The main objective of costing is to ascertain cost of each product, process, department, service, or operation. We have to see how much this department costs. What is the pay bill of this particular department? Can we merge this department with some other department and reduce the people so that our expenses will save? Cost. Now what banks are doing? If any bank is going in loss, government does? Government merge that bank with a bigger bank. because there is computerization in banking now. You see, any data computer can take. You see, care. So loss, the bank which is making loss, it is merged in a bank. You see, which is in profit. Or if the performance of a bank is not good, government will merge it with some, you see, bank whose performance is good, and slowly this bank, you see, merged with, you see, uh, performing bank will also become performing. You see, cost can be classified into different categories depending upon purpose of their, you see, classification. Classification by nature or element, functional classification, classification on the basis of, you see, behavior, classification on the basis of, you see, managerial decisions, you see, making and control. Now, classification of cost on the basis of nature or element, you see, direct cost, indirect cost. Now, direct cost, indirect cost towards material, towards labor, towards, you see, expense. Now, direct costs. These are costs directly attributable to producing a product. The following, you see, comes under the direct cost: direct material cost. You see, it is a cost of material which can be directly allocated to a, you see, cost center. Example, raw material, you see, consumed for production of a product. Suppose, you see, you are having a plastic, you see, factory. You are making all these plastic buckets, you see, magga, all these items, plastic you are making. So the raw material, you see, which you will buy, uh, we will be considering, you see, cost of that. Then labor, direct labor cost. It is the cost of wages of those workers who are readily identified or linked with cost center. Those who are working in the factory, you see, those who are manufacturing the goods. So that is, you see, labor cost, direct labor cost. Then direct expense. These are the expenses other than direct material or direct labor, which can be identified with cost center. You see, other expenses. These expenses are not of, you see, material expenses, not of labor, but other expenses which are incurred for manufacturing. You see, these particular, you see, plastic buckets, magas, etc. What, for example, what can be, you see, those expenses? You can say freight inward. You know, some, if you have brought this raw material, if you have brought the amount spent in, you see, transportation costs. Then indirect, then these were all direct, you see, which are concerned with the manufacturing of that particular, you see, item. These were those costs. The next is, you see, indirect costs. These are the costs which cannot be assigned to any particular cost unit, that is job, product or process, you see. Now, indirect material which cannot be directly allocated to a particular cost center, you see, the material, you see, costing of that material. Then indirect labor. These are the wages of employees which are not directly, you see, allocable to a particular cost center, those who are not, you see, at the factory. They are in the office. Indirect expense. These are the expense other than the nature of material or labor and cannot be directly attributable to a particular, you see, cost center. Say sales expenses. Now, next is, you see, functional classification. Now, what do we mean by prime cost? Prime cost is direct material cost plus direct labor cost plus direct expense cost. This means this cost will tell us that how much, you see, amount incurred for manufacturing these, you see, so many units, the final result. Suppose 1000 units we have, you see, produced. So this much amount is incurred for producing this, you see, final goods. Factory cost. What is factory cost? Prime cost plus factory overheads, you see, expenses in the factory, you see, wages of the, you see, supervisors, and other, you see, people which are in the factory. Then opening stock of work. What was the opening stock of work? You see, in progress also, minus closing stock of work and work in progress, you see. So how we'll come to know about the factory cost, prime cost? In this we will add, you see, factory expenses, factory overheads, plus we'll add in this, you see, opening stock, and we will reduce closing stock from this. Now cost of production will be, you see, factory cost plus administrative, you see, overheads, plus research and development, you see, overheads. That is cost of, you see, production. The next is cost of goods available for sale. Cost of production plus opening stock for, you see, finished goods. So that is the cost of goods available for sale. Now cost of goods sold, you see, cost of goods available minus closing stock of, you see, finished goods. So total cost is equal to cost of goods sold plus selling and, you see, distribution expenses. This was about functional classification. Now we come on the cost sheet. Cost sheet is a detailed statement that shows the cost incurred at every stage of production. You see, we have studied about different stages of production, along with a breakdown of the, you see, total cost. It is used to determine the cost per unit of a product, and can be, you see, prepared periodically to track the cost, you see, performance. Now structure of cost sheet, you see here: direct material cost, direct labor cost, direct expenses, prime cost, sum of direct costs. In this we add factory overheads, factory cost, prime cost plus factory overheads. In this we add administrative overheads. We get cost of production, that is factory cost plus administrative overheads. In this we add selling and distribution overheads. Then we get, you see, total cost. So total cost is total cost of production plus selling and distribution overheads. In this, you see, we add profit, you see, margin. Then we arrive at, you see, selling price. You see, this was structure of, you see, cost sheet, which we have studied in the earlier slide also. Now we come on the next is, you see, classification on the basis of behavior. You see, first is fixed costs. Costs which do not vary with the level of production are, you see, known as fixed costs. Say, for example, cost of the machinery, cost of the, you see, this premises of the factory, you see. So these are fixed costs. They are not going to alter. Next is variable cost. Variable cost, you see, costs that vary in direct proportion to volume of production. If you will increase the volume of production, your this variable cost will, you see, increase. If you reduce the volume of production, your variable cost will, you see, reduce. Now semi-variable costs, costs which contain both fixed and variable components are called semi-variable, you see, costs. The costs which are containing both fixed and variable components are called semi, you see, variable costs. Now classification on the basis of, you see, managerial decision making and control. You see, marginal cost. What is marginal cost? Marginal cost is cost of producing one additional unit. It is useful for, you see, price fixation. You see how marginal cost is to be used. It is used for, you see, price fixation. So marginal cost is cost of producing one additional unit. Next is, you see, opportunity cost. It refers to the value of sacrifice made for benefit of opportunity foregone in accepting an alternative course of action. So what is opportunity cost? Opportunity cost refers to the value of sacrifice made for benefit of opportunity foregone in accepting an alternative, course of action. The next is normal and abnormal cost. Normal costs are normally incurred at a given level of output, while abnormal cost is an unusual or unexpected and due to some abnormal situation of the production. Now next is sunk cost. It is a cost which has been already incurred or sunk in the past. So it is not relevant for the decision making. It is not taken into account, in the present time. Imputed cost, the cost which do not involve any expenditure in real sense. They included in cost accounts only for taking, managerial decisions. They are not, to be included in the expenditure. Only for managerial decisions, they are just seen. They are, to be seen, to be noticed. Next is, nature of cost accounting. Cost accounting is an organized, body of knowledge. These certain principles to which the technique of costing should be applied. These principles and rules have been developed over a period of time by experience. Besides being a science, cost accounting is an art also. Its principles, rules, and techniques are not static, but they are dynamic. Although it is an organized body of knowledge, its principles cannot be verified and proved by experiments. Hence, it is not an exact science. Since it is operated by human beings, so it is a behavioral science. Old principles and techniques are, replaced by new. It not only lays down the rules, but also shows the way of achieving the objectives for which it is, installed. Now, what is the scope of, cost accounting? Cost ascertainment, in this region of cost accounting, it collects products, material, labor, and overhead cost and try to calculate total and per unit cost of the product. This total cost, will be based on historical or standard or estimated basis. After this, cost accountant will use any method of costing like specific order costing, operation costing, and direct costing technique. Next is, cost records. In this part of cost accounting, cost accountant maintains cost books, vouchers, ledgers, reports, and other, cost related, documents for future comparison and reference. It will also be under the scope of, cost accounting. Next is cost control. This is the end boundary of cost accounting scope. In this division, cost accountant use different techniques and methods for controlling the cost. Save 1 rupee in the cost of product means we have earned 1 rupee in the production of goods. This is very important. Save 1 rupee in the cost of product means we have earned 1 rupee in the production of goods. So cost accountant uses budgetary control, standard costing, break-even point analysis, and many other techniques for controlling the cost. Now, what are the advantages of costing? Cost accounting is not only helpful to provide, cost information for internal use by management, but it also helps, management in setting objectives and programs of operation in comparing actual performance with, you see, expected performance. Benefits are, you see, provide data and cost information, you see, disclosure, you see, operating efficiency, helpful in, you see, decision making, maximum utilization of, you see, resources, helps, you see, financial accounting, you see, helpful in, you see, avoiding losses. In 1969, you see, during Indira Gandhi's regime, banks were nationalized. Why banks were nationalized? Prior to that, banks were giving service only to rich people. Banks were owned by Tata Birla, so they were entertaining only, you see, rich people. So in 1969, during Indira Gandhi's government, banks were, you see, nationalized. 14 major commercial banks were nationalized, like Central Bank of India, Syndicate Bank, Union Bank, Indian Overseas Bank, United Bank of India, United Commercial Bank, Allahabad Bank, you see, Corporation Bank. And after this, you see, after a few years, 5 more banks were nationalized. So total 19 nationalized banks were there. So our entire country, there are, you see, districts are there. So entire country was, all the districts were allotted to, you see, these banks, and government asked banks to do the survey of the, you see, village and find out what is the scope in that village. You see, what can we produce in that particular village, you see, whether for production of that particular commodity, cheap labor is available, where raw material is, you see, available, cheap raw material is available. So banks did that work, and then, you see, bank opened branches in those areas, and then they started financing in those, you see, activities. That was just to, you see, so that the cost of the goods, you see, produced there, you see, in the areas where the scope of that particular activity was there, you see, cost will be less. So they can, you see, those industrialist businessmen, they will come and, you see, put up those type of industries there. So prior to that, in our country, you see, no bank was giving loan to agriculture, then retail trade, small business, professional and self-employed, you see, people, education loans, export credit, pre-shipment, post-shipment, then small-scale industries. So after nationalization only, you see, government started giving loans in these activities, and so much, you see, industrialization, you see, took place in the country. You see, now car loans, you see, education loans. So many students, you see, they were deprived of further studies because they were not having money for, you see, further studies. So banks, you see, financed for, you see, graduation courses, for post-graduation courses, and those loans are available very easily. And that student only has to return those loans when he will, you see, gainfully when he is employed. So now, because of that, you see, so many students are, you see, studying. Similarly, cars, we see so many cars. In housing sector also, there is a lot of development. So that why I am telling you this is because those districts where, you see, they saw that the cost of the particular items manufactured in those particular districts where cheap labor is available, raw material is available in those districts, you see. So the cost of the unit will come out to be less compared to manufacturing of that particular, you see, commodity in some other district. So they did survey. So that is why, you see, where the cost was, you see, less, they people you see opened those industries in those areas, and then they made you see profits were more. So we were studying benefits of cost accounting. You see, they have to you see study, you see, collect the information, and then they have to see that how can we you see save, you see how can we save per unit cost, what shall we you see do, provide data and cost information, disclosure operating you see efficiency, helpful in decision making, maximum utilization of resources, you see, helps financial accounting, you see, helpful in avoiding you see losses. Yes, you see, its study also will help in you see, avoiding losses, because company will take you see decisions you see prior to you see going in loss. Then now relationship between cost accounting and management you see accounting. So the object of cost accounting is to record the cost of producing a product or providing a service. You see, its object is to record what is the cost of you see producing or providing a service. The cost is now, for example, you see one ATM. You see, suppose one ATM is there, and if you see number of hits daily in that ATM is not up to a you see a level, suppose one ATM is there, and if you see number of hits daily in that ATM is not up to a level, Now we are going to study the relation between, you see, cost accounting and management accounting. Object the object of cost accounting is to record the cost of producing a product or providing a service. The cost is, you see, recorded product wise or unit wise. Besides recording, it deals with, you see, cost control, matching of cost with the revenue, and decision making. You see, the purpose of management accounting is to provide information to the management for planning and coordinating the activities, you see, of the business. The management will, you see, look for the, you see, expansion of the unit or any particular product which is having, you see, good sale. So they will increase the production of that product. And if a product, the sale is not much, they will reduce the production of that particular product. Next is scope. The scope of management accounting is very wide. It includes financial accounting. They will see, you see, the profit and loss account, trading account, balance sheet. They will compare the balance sheet of, you see, this particular year with the last, you see, year. And they will, you see, ask the accountant to prepare the projected balance sheet, you see, of future years. And you see, the scope of management accounting is very wide. It includes financial accounting, then cost accounting, then budgeting, you see, budget figures, then tax planning, you see, reporting to management and interpretation of financial data. On the other hand, cost accounting deals, you see, primarily, you see, with the cost. Then nature, management accounting is generally concerned with the projection of, you see, figures for future. The policies and plans are prepared for providing future guidelines. Cost accounting uses past and, you see, present figures. Then data used. In cost accounting, only those transactions are taken which can be expressed in figures only, you see. Quantitative aspect is recorded in cost accounting. Whereas, you see, in management accounting, you see, we use the data, quantitative data as well as, you see, qualitative information we are using in management accounting. The next point is development. The development of cost accounting is related to industrial, you see, revolution. They have to, you see, look after the cost. They compare the cost of the same product manufactured by other, you see, industries. They compare, then they see how can we reduce the cost, what, you see, other features we can add to this particular product. Financial accounting could not satisfy information need of, you see, management. Cost accounting was thus evolved as supplementary, you see, accounting methods. Cost accounting was able to provide information not only about cost structure but also for planning and decision making. You see, management accounting has developed only in the last 30 years. Management accounting and cost accounting are both, you see, complementary subjects. You see, principle followed, certain principles and procedures are followed for recording cost of different, you see, products. The same rules are applicable at, you see, different times too. No specific rules and procedures are followed in reporting management accounting. The information is prepared and presented as is required by the, you see, top management. Next is, you see, absorption costing and marginal costing. Absorption costing, also known as, you see, full costing, is a method of costing that assigns all manufacturing costs to the product. These costs include direct costs, direct material, direct labor, indirect costs, overheads, both variable and fixed manufacturing, you see, overheads. Under absorption costing, both fixed and variable production costs are absorbed by the units produced. This means that each unit of product includes a share of, fixed manufacturing cost in its, cost. Some portion in the cost will be of, which is pertains to fixed cost. Marginal costing, also known as, variable costing or direct costing, is a method of costing in which only variable costs are charged to the units. Fixed costs are not charged. The fixed costs are treated as, period costs and are written off in full against the contribution, for that period. Slowly, with the depreciation, any machinery, it will depreciate every year. And after 10 years, its value in the books will become zero. Now, key approaches, key aspects are variable costs that vary directly with the level of production, such as, direct material, direct labor, and, variable overheads. If suppose it is directly proportional to these expenses, the more is the production, the more is the cost, the more is the cost. Then fixed costs that remain constant, irrespective of the level of production, such as rent, salaries, and insurance. So if, we have increased the production, the units produced are more compared to last year, our fixed cost will remain the, same. It will not change. Only the variable costs, mainly the raw material cost, will, increase when, suppose, if we are doubling the production, if our production is doubled compared to, last year, so labor cost will increase, then raw material cost will, increase. But the fixed costs, that is the machinery, which we purchase and it will last for 10 years, then our, premises, whether owned or rented, that will not, increase, that will remain same. Then salary of office staff also will remain same. Now, next is absorption costing versus marginal costing. Absorption costing allocates both variable and fixed costs to the product. Both are charged in the product, both are counted. Marginal costing allocates only variable cost to the product, with fixed costs treated as period expenses. They are not taking into account fixed cost while calculating marginal costing. In absorption costing, both are taken into account. Variable cost as well as fixed cost. The next is impact on profit. Absorption costing can show higher profit in periods of, increasing inventory, because fixed costs are, deferred in the closing stock. In marginal costing, it shows consistent profit irrespective of inventory changes, as fixed costs are expenses in the period, they are incurred. They are not to be taken into account afterwards. Decision making, absorption costing, it is less useful for decision making as it includes fixed costs in, product costs. Marginal costing, more useful for decision making, especially in determining the impact of, different production levels. Then reporting, absorption costing used for external financial reporting as it is required by, accounting standards. Marginal costing, primarily used for internal decision making and management reporting. Now next is break-even point. What do we mean by break-even point? That point of sales, volume at which total revenue is equal to total cost. It is a point of, no profit, no loss. In any industry, when, a point of sale will come when, revenue is equal to total cost. So after that, up to that point, they will, produce. After that, they will not, produce. After that, they will see that if they will produce further, we will go in loss. So it is a point of no profit, no loss. So at break even point, total sales is equal to total, cost. The break even point can be computed in terms of units of sales volume, and second method is budget total, or in terms of, money value, that is rupees. So units of sales volume, break even point in units can be calculated. The formula is break even point is equal to fixed cost divided by selling price minus variable cost per unit. Selling price per unit minus variable cost per unit. Or second formula is break even point is equal to fixed cost divided by contribution, per cost. Units of sales volume, fixed costs, those costs which do not vary with changes in volume of output. Variable cost, those costs which fluctuate to the volume of output. The output, if the output increases, variable cost also increases because more raw material will be used, more labor will be employed. Contribution, it is the difference between sales and variable cost. It may be defined as the excess of selling price over variable cost. Now budget total, or in terms of money value, break even point in rupees can be calculated. The formula is break even point in units is equal to fixed cost divided by sales minus variable cost multiplied by sales. So, or break even point is fixed cost divided by contribution multiplied by sales. We can find break even point with the help of profit volume ratio also. Profit volume ratio, PV ratio, is equal to, it is also called contribution ratio or marginal ratio. Express the relation of contribution to sales, or it shows the relation between the contribution and sales. Break even point is equal to fixed cost divided by profit volume ratio. Profit volume ratio is equal to contribution divided by sales. So our break even point is equal to fixed cost divided by contribution over sales. Now next we are going to study activity based costing. Activity based costing is a costing methodology that assigns overhead and indirect cost to specific activities, which are then traced to products or services based on their consumption of those activities. This approach allows for more accurate and meaningful cost information, aiding in decision making, pricing, and performance measurement. Now, enhanced cost accuracy. Activity-based, costing provides a more precise allocation of overhead costs by linking them directly to activities, leading to more accurate product costing, improved decision making. By understanding the true cost of products, services, and customers, business can make better decisions regarding pricing, product mix, and cost management. Identification of non-value added activities. Activity based costing helps in identifying activities that do not add value to the product or service, enabling businesses to reduce or eliminate such activities. Business will then eliminate such activities, leading to cost saving. If activity-based costing helps in identifying activities that do not add value to the product, if they are not adding any value to the product or service, then naturally they will be removed. Enabling business to reduce or eliminate such activities, so that the cost will reduce. Better resource allocation. Activity-based costing provides insights into resource consumption, allowing for more efficient allocation of resources based on actual usage rather than you see arbitrary cost allocation, facilitates continuous improvement by highlighting cost drivers. Activity based costing can be used as a tool for process improvement and operational efficiency. Now, what are the objectives of activity based costing? The objectives are accurate cost allocation, to allocate overhead costs more accurately to products and services based on their actual consumption of resources, understanding cost behavior to gain a better understanding of how and why costs are incurred within the organization, improving cost management to identify and eliminate non-value added activities, you see, thereby improving overall cost, you see, management. Again, they will eliminate, you see, non-value added activities so that the cost will reduce. Enhance, you see, decision making to provide management with the detailed and accurate, you see, cost information for better strategic and operational, you see, decisions. Then next is profitability analysis to assess the profitability of products, services, and customers by providing a more accurate cost basis. Next is, you see, merits of, you see, activity based costing. What are the merits? First merit is precision in costing. Activity based costing, you see, provides more accurate product and service costs by focusing on actual resource consumption. Next is focus on cost drivers. Activity based costing identifies cost drivers, enabling managers to understand the root causes of overhead cost and manage them, you see, effectively. Informed price decisions. Activity based cost with accurate cost information, businesses can set prices that reflect the true cost of production, leading to better, you see, profitability. Identification of, you see, inefficiencies. Activity based costing helps in spotting inefficiencies, you see, by identifying activities not that consume, you see, excessive resources without, you see, adding proportional value. If, you see, more raw material is used but production is not increased, so that will come to know. Then sports strategic decisions. Activity based costing provides detailed insights into the profitability of, you see, different segments, supporting strategic decisions like product line extensions, discontinuations, or, you see, if any outsourcing is to be done or not. Now, what are the demerits of, you see, activity based costing? Number one is complexity. Implementing, you see, activity based costing can be complex. It can be complex and it can be time consuming also. It can be, you see, requiring detailed data collection and analysis of that data, you see. Then costly implementation. The process of setting up and maintaining an activity based costing system can be expensive, particularly for small or medium sized enterprises, you see. So it is good for, you see, big size businessmen. It is good for big size businessmen. It will help them. But to small or medium size, you see, micro, medium enterprises, it will be, you see, costly for them. Then data intensive. Activity-based costing requires significant data on activities and cost drivers, which can be, you see, difficult to obtain and maintain. Potential for overhead allocation, if not carefully managed, activity-based costing can result in the allocation of, you see, too many costs to certain activities, distorting, you see, product costs. Product cost will increase, you see. Resistance to change. Employees and managers, you see, may resist the adoption of, you see, activity-based costing due to its complexity and the changes, you see, it necessitates in the organization's process, you see. Like when computerization, you see, came, so the staff, you see, they were used to do manual things, you see. They did not come to know about the benefits of computerization, but they insisted that change should not be there, old procedures should be, you see, followed. But still companies, they did it. So resistance to change, there was a resistance from the staff, but still companies, you know, they did it. So employees and managers may resist the adoption of activity-based costing due to its complexity and the changes it necessitates in the organization's, you see, process. They will not, you see, like, they want that old procedures to continue, because by following those old procedures, they can do their job very fast. They can do their job very fast. They were used to the old setup. Now with this, you see, they will resist. Now process in activity-based costing, you see, identify activities. The first step is to identify all the activities involved in the production of goods or services. Which are the activities, you know, how many activities are there. Then assign costs to activities. Each activity will be assigned the cost. Direct and indirect costs are assigned to each activity based on actual, you see, consumption. Then determine cost drivers. Identify the factors that drive the cost of each activity, that is machine hours, labor hours. Then calculate activity rates. Determine the cost per unit of activity by dividing the total cost of each activity by its total cost driver units. Then assign costs to products, services. Finally, allocate the activity costs to products or services based on their consumption of each, you see, activity. So this was our last slide. So we have studied about the limitations of activity-based costing. So it is high implementation cost, then complexity and resource intensified. Next is not suitable for all industries. Then potential for misinterpretation, difficulties in, you see, change management. Okay, students, we are closing the session. Thank you very much, students. आपका क्या नाम है? आपका नाम क्या है? शेखर। थैंक यू बेटा।